after the training. So today is going to be a hands-on training. So we want to look into the methodology in creating a trading strategy. Right? I want to believe you all can hear me clearly. Okay? Awesome. Right? So a quick one now. So we just move to looking at the methodologies we are going to be viewing. Because it's very, very important. I will be showing you the methodologies we'll be going through. So we'll be looking at 10 methodology in creating a trading strategy that works. Number one, we will look at what type of trader are you. Number two, we would look at what type of what time frame works best for you. Then we'll look at number three, we'll look at what currency do you want to trade. Then number four, determine your entry point. Number five, determine your exit point. Number six, what candlestick pattern do you look out for? Number seven, what chart pattern do you look out for? Then number eight, what's your risk to reward ratio? I don't know. I'm coming. Okay. So, what's your risk to reward ratio? Number 9, what's your risk management? Stop loss, take profit. Then number 10 strategy is backtest your strategy to evaluate your performance. So let's progress. Now, when we look at the number 1 strategy, which is what type of trader are you? That's our number 1 strategy. What type of trader are you? You need to understand that each trader has a unique trading style that fits into the different types of personalities. Now, if your personality does not match your trading style, this might hurt your account badly and make you lose money consistently while trading. And you don't want to be that person anymore who is susceptible to losing funds on trades. So you need to understand what type of trader you are. It's very vital. What type of trader you are. I'm waiting for you for your comment session, guys. Okay. What type of trader are you? Now, trading style, like the graphics I've presented here, for every traders are different, and you need to understand that. You need to know what trading style fits you as a trader, because understanding what trading style fits you as a trader makes you to be able to develop your strength in that area. So we have 4 types of trading style, which I'll be taking you through today. 4 types of trading style. Number 1, we have the scalping. Number 2, we have day trading. Number 3, we have swing trading. Number 4, we have position trading. Right? Now, for scalping, how does scalping works? Scalping has to do with holding a position for several minutes. Now, how do I mean holding a position for several minutes? Now, let me do a quick illustration of scalping so that you can actually get what I'm saying. So, Now let me pick this pen. So a scalper enters a trade at this level, at in the time frame that is the almost the lowest time frame. Let's say like 1 minute to 5 minute time frame. That's what scalpers use. So they enter into the market so fast. So within 1 minute, they are in and out, and they've taken profit. Right? They are in and out, and they've taken profit. All right. So a scalper comes in the market very fast, very swift, and before you know, he's out of the market, so fast. So a scalper, is a trader that holds position for just few minutes, from 1 to 15 minutes or 30 minutes. That is the max. So a scalper targets as a short time entry and exit, time frame, right? Now, for the second type of trading style is day trading, right? Day trading. Now, what does day trading do? A day trader holds position for a day or less, which means a day trader is that trader that trades within 24 hours. Within 24 hours, right? So a day trader is that trader that loves to trade within 24 hours. So it's that kind of trader that does not want or does not take his trade to another day. Does not allow his trade to exceed or glide into another day. So a day trader trades within 24 hours. You might trade for 1 hour, 2 hours, 3 hours, 4 hours, 5 hours, 6 hours, 7 hours, 8 hours, 9 hours, 10 hours, 20 hours, 21 hours, 23 hours, 24 hours. A day trader trading within a day. That's a day trader. So let me just reiterate. A day trader is that trader that holds position for a day, right? For a day. I want to believe you guys are following me, right? Awesome. A day trader is more that holds trade forward for a day. Now, the third one is a swing trader. Now, a swing trader is that trader that holds trade for several days, right? A swing trader is that trader that holds trade for several days. Today is Monday. He picks a trade and then allows it to go day 1, day 2. The trade is still running. That same trade he has opened on Monday is still running on Tuesday. It's still running on Wednesday. It's still running on Thursday. It's still running on Friday. And then he closes it. So a day trader is that trading style where a trader holds position for more than 1 day, right? For more than 1 day, for several days. 1, 2, 3, 4, 5, days. Now, but a position trading is that trading style where you hold position for several weeks and even months, where a trader picks a position and leaves it to keep running for weeks. Week 1, week 2, week 3, week 4, week 5. That's a position trader, right? Now, this is how to develop. This is your number one strategy on how to develop your trading strategy. Number one methodology. So number one, when you want to develop your trading strategy, be writing it down now. Be taking notes. What type of trader are you? I am a scalper. I love to take trades within few minutes. Oh, I'm a day trader. I love to hold my trades within a day and close them before the next opening day. And oh, I'm a swing trader. I love to see my trade run for several days but not weeks. Oh, I'm a position trader. I love to see my trade run for weeks and even months. So you need to understand what type of trader are you. That's your number one methodology to becoming a profitable trader, right? Number 2 is what time frame works best for you. what time frame works best for you. Now, is there a best time frame to trade forex? This is a common question actually that a lot of traders ask, especially those who are new to the forex market. The truth is, there is no single answer to this. There is no single answer to this. It all depends on your preferred trading strategy and style. It all depends on your what? Your preferred trading strategy and style. Don't forget, I took my time and I explained to us that number one methodology is what type of trader are you. And in this session, in this methodology, I explained the different trading style, which is scalping, trading, day trading, swing trading, and position trading. Now, the number two methodology is you knowing what time frame works best for you. Of course, there might not be a particular time frame that works best for you, but then there is, since you've been able to figure out what type of trader you are, it will help you to know what type of time frame you focus on. Right? You want to know what type of time frame you focus on. Now, yeah, look at this table here that I have drawn, for you. Okay? Now, this is chart. This is scalping. This is day trading. This is swing trading. This is position trading. Like I explained, and I would reiterate again, what time frame was best for you depends on your preferred trading strategy and style. Right? Now, if you look at it now, you want to look at, okay, are you the type of trader that loves to target a trend chart, and then you are looking at taking trades within the time frame of 1 to 15 minutes? Like, you love to use the 1 minute time frame, you love to use the 2 minute time frame, and then you love to use the 4 minute, the 5 minute, the 10 minute time frame, the 15 minute time frame. You are a scalper. You love to scalp. You are scalping. So now, your trading style would help you to understand, the time frame you need to work with. Right? This is your number two methodology, and it's very critical. Now, day trading, when you see yourself as a day trader, you are looking at a time frame of 30 minutes to 4 hours, which means you are that kind of trader that looks to take position within a day, within 24 hours. You want to look at positioning yourself within using the 30 minutes to the 4 hours time frame. Now, let's talk about the swing trader. Now, swing trading, like I said earlier on, is that trading style where a trader holds position for days, several days, day 1, day 2, day 3, day 4, day 5. Then we have the position trading. This trading style, has to do with holding position for several weeks. Week 1, week 2, week 3, week 4, and even days. So these are the number two methodology, which means the time frame that is best for you is in correlation, works hand in hand with what type of trading style you are going to adapt, or you are adapting. Are you a scalper? You want to know that. You need to answer that. Are you a day trader? You need to answer that. Are you a swing trader? You need to answer that. Are you a position trader? You need to answer that. Alright? Awesome. I want to believe you guys are following me and you are learning a lot from this class. I'm sure you are learning a lot because I'm taking my time to break it down for you. But I would love to get feedbacks, if any, and then I'm open to questions. So you want to ask a question, go ahead. Number 3. We have number 3 methodology of creating your own profitable strategy is what currency do you want to trade? What currency do you want to trade? This is very, very vital, right? You need to choose, you need to know what currency you want to trade. So you are not just coming and saying, oh, you want to just jump on any currency, right? Because trading currency is different from any of your day-to-day buying and selling activity. It's different. Just like you just go out and say, oh, I want to buy something in the market. So trading currency, buying and selling currency is different from your day-to-day buying and selling activity. You need to understand the drivers today. You want to understand that, right? I want to know if we are following. Please, I would appreciate. I would like to know if we are following, right? Okay. Fantastic. Yeah, I want to know if you are following. Thank you very much. Okay. Anthony, you said I'm a day trader with a touch of swing trader. Also, good to know. Good to know that. Awesome. So you need to know. So number 3 methodology is, what currency do you trade? Now, as you can see here, the most traded currency pair we have Euro USD is traded 28% out of 100% of the currencies being traded. So which means a lot of persons love to trade Euro USD because it's a more volatile pair. Then followed by USD JPY. Then followed by GBP USD, the pounds, the dollars. Then followed by Australian dollar and the US dollar, followed by the US dollar and the Canadian dollar, followed by the US dollar and the Swiss franc, followed by the New Zealand dollar and the US dollar, followed by the euro and the Japanese yen, followed by the GBP, the pounds and the Japanese yen. So followed by the euro and the pounds, followed by the Australian dollar and Japanese yen, followed by euro and Australian dollar. So you can see the flow. Now you want to know, what currency would you love to trade? Oh, I would love to trade only Euro USD. There are traders who say, oh, I would love to trade nothing but Euro USD. And some traders would say, oh, I would only trade currencies with the USD pair. And some traders would say, I only trade gold. Anything outside gold, I don't trade. And some traders would say, I don't want to trade Euro USD. I only want to trade USD CAD and USD CHF. Some persons would. So you need to just choose, what currency suits you, right? What currency pair you want to trade. If a day, like if you want to trade now, you need to look at the currency pair you want to trade. You need to understand the driver, So before you don't just jump on currencies without knowing what is driving them, the fundamentals driving them, the news, the macroeconomics news, probably driving the coin at the moment. Number 4 methodology is determine your entry point. Determine your entry point. I want to believe you are taking note. We've moved from 3 to 4 now. Determine your entry point. So from number 1, we said, what type of trader are you? Are you a scalper? Are you a day trader? Are you a swing trader? Are you a position trader? Number 2, we say, oh, what time frame works best for you? And we conclude that the time frame that works best for you is in correlation, and it depends on your trading style and strategy. Then number 3, we've talked about, what currency do you want to trade? It's a big question you need to answer. Are you interested in trading Euro USD? Are you interested in trading Euro, USD pairs? You need to determine that, right? Good. So these are part of your methodology. Number 4 methodology. Number 4 is determine your entry point. At what point will you take position in the market? Right? At what point will you take position in the market? At what point will you strike a buy? At what point will you strike a sell? You need to understand that, because that's part of the step, in achieving a successful trade. All right. So number one, you want to choosing levels or level picking, which is an early entry. You want to choose levels. Okay, this one is more practical now, so I'll take us to our chart. Now, number two is confirmation signal. Having picked a level, now you want to seek for a confirmation, right? A confirmation on, should I take position, should I buy, or should I sell? So there would be, first, you choose a level. Second, you want to get a confirmation signal. Third, you want to look at the momentum entry, which is waiting for a breakout of a certain level, right? Okay, let's jump on our chart so I can explain that very well. Now, you look at this chart here. I took a trade at this level. So I took a trade at this level. Now, you are looking at it that you are expecting look at this level here. This is a level, right? This is another level, right? Now, when the trade came down to this place and went up here, it came down here again and went up to this level, right? Now, you are looking for a confirmation. What confirmation would I look for at this level? Because I'll look for a breakout of this level in which that breakout was experienced at this level. Coming. See, that breakout was experienced at this level. That breakout was experienced at this level, right? There is not so a significant breakout, but you can see this candlestick here, this green candlestick covering up this previous three candlestick. The last three candlestick, this green candlestick came up and covered it, and this is our daily time frame. We are on the daily time frame, so it poses a more significant momentum, right? So we have this bullish candle here. You call it bullish engulfing candle. See it came up here and it engulfed these previous three candles. It shows the strength, of the candle, the strength of the buyers coming in, covering the previous 3 days. That's a good signal. Then the market jumped up, got here and closed above these previous three candles. Now, yes, number one, we have chosen our level. We've identified this place as a level, right, where we spotted the engulfing candle. Now we now have to wait to see if there will be a breakout of this level, and then we know if there is a breakout of this previous resistance level, because we know that this level has been a previous resistance level, right? Has been a previous support level. So it came here, it turned resistance. So we want to look at it. Would this level of support turn resistance? Would it resist this price from going up, or would it push it back down? So we saw that the next candle opened and it moved up, right, out of this resistance level. When it moved up, it came down. So this is our signal. It signals a confirmation. So when this other candle opens and closes above the engulfing candle, it's a signal that it's a valid buy. If you want to buy, right, if you're looking for a buy position, it's time to take a buy position at this level. Then if you are taking a buy position at this level, you see the market rise together. Now, so we first spotted the level, and then we looked at where we want to come in, right? Looking for a confirmation, and the confirmation was gotten. Okay, let me see if okay, now look at this trade here. Look at this Euro USD, right? Now, as we can see, the market went up here. There was a bullish candle here, went up. Now, on the 4 hours time frame, if you want to catch quick trade on the 4 hours time frame, you can see that there was a downward trend, a drop in candle, and then the last candle that closed formed a pin bar after a consistent drop of the market, right, in the 4 hours time frame. So if I want to take a position in this market, of course I took position in this market this morning and I short the market, right? Now, if you want to take position from here, we now consider selling, right? Why? Because there was a movement here, a bearish momentum here, but we know that, okay, now a bearish momentum is coming in. We need a confirmation, and that confirmation is that we need the market to break down below this consolidated level, this level that consolidated for the last, this single candle here is 4 hours, this single candle here is 4 hours, this single candle here is 4 hours. So this 3 candle like this alone is 20 hours, right? Because this is 4 hours plus 4 hours, that's 8 hours, then plus 4 hours, that's 12 hours, right? This is 12 hours, right? Now, so this candle consolidated for 12 hours at this level, giving us a signal that this level is a resistance, is a support level, trying to keep the price from dropping further. But our confirmation would now be, if price drop further below this level, I'm going to short this market. If price drop below this level and close below this level, I'm going to short this market. So when I saw price dropped below this level, I short the market, right? So right now, if I want to take this trade with you guys now, I would consider shorting the market. Here it is because there has been a drop in price, right? And then a pin bar after that drop in price, when price tried to reject back up, and there was a pin bar, right? So if you are considering this type of trade, you want to look at the big picture, right? So you can see that the market has actually gone up to this level, came down, went up to this level, formed a double top. So you can see a double top here, and then the market dropped. There's a more chance and higher possibility that the market will continue to drop to this level, Now, if the market gets to this level, might reverse back to this level. If it doesn't reverse back to this level, if it breaks out of this line here, we might see a continuous fall in price, right? Awesome. So what do I want to do here with you guys is, let's short the market, right? Let's short the market here. Okay. Now I'm taking this practical with you. So we've taken a short position here. Oh, sorry. What's going on? I'm coming, please. Okay. Okay, I want to short this market. Okay, so we've short the market, right? So I'll be using this trade as an example as we are going to tell you time frame, like I've explained. This 1 hour time frame, then show you entry points, which I've done, then back to our trade, back to our chart, Then we look for momentum, confirmation signal, blah blah blah. Okay, the next one is determine your exit point. Determine your exit point. So how do we determine our exit point? An exit point is the price at which a trader closes a position. So I've opened a trade now, and I'm looking at closing the trade. Now I think now look at this. Okay, I want to make you guys to see what I'm trying to illustrate clearly. Okay. Okay. Coming. So I want to make you guys see it clearly. That's why I'm doing this. Now, so you can see here now, we took a sell, right? A sell at this level, and we've sold this Euro USD, the trade. We've sold it. Now, so let's go back to our chart now. Now, we want to look at what point. What we just did was we've determined our entry level and we've entered the market. We have a running trade now. Now, we want to determine an exit point, right? The point at which we want to leave the market. Okay, we are done trading, we've made our profit or we've made a loss. So how do we exit the market and we close in profit? Or how do we exit the market that we manage our losses so that we don't lose more than we can bear? So I will take us through it now. Please pay attention. So now I will take us through two strategies to determine our exit point. It is very interesting and fantastic to enter into a trade, but it is also very critical and important to know when to jump out, to know when to exit the market. So that, okay, I'm done for today. I'm glad I've made some money. I'm glad I lost, a little and not more than I can bear. So you need to put all those strategies in mind, because you might take a position. Not all your positions would end up in profit, right? Not all your positions, because the market is dynamic. Then you need to either prevent yourself from losing more than you can bear. So now we have two strategies I'll be talking about here under the determining your exit point. Number one is the stop loss strategy. The stop loss needs to go, where they get you out when the security, which is the currency, is volatile. Now when the currency violates the technical reason you took the trade. So now we've taken that trade that we took because we said, okay, there was a consolidation for 12 hours at a particular level we tagged as the support level. Now that support level was finally broken, and we anticipated a continuous fall because we saw after that support was broken, two candles on the 4 hours time frame also dropped, and currently we have another candle, which is the last candle now, and now we are taking position to further sell it off because we believe that the market will go down. Right now, what if the market did not go as planned? What if for some technical reasons the security violates the reason why we took the trade and it goes bullish? What should be our plan? That's our exit strategy, our stop loss strategy. Now, okay, let me explain the scaling exit strategy so that I would give the illustration together. Now, for the scaling exit strategy, is is that approach where you raise your stop to break even as soon as a new trade move into a profit is formed. This can build confidence because you now have a free trade, right? Now let me give you a practical illustration of what this means. Now the stop loss strategy and the scaling exit strategy. Now look at what the stop loss strategy is talking about. The stop loss strategy says that we want to determine the level where we want the price to get to and stop us out of the market if the price is not going in our favor, right? So because we short the market, we are expecting the market to drop further. Now, but if the market did not drop further and decided to go higher, at what point should the market stop and deactivate the trade? That's why we have stop orders. We'll look into stop loss today. It's part of our strategy, stop loss. So now we look at it. Okay, fine. I've taken this trade at this level, and I want to put my stop loss at the next resistance level. Look at it at this level here, where we waited for a price to drop, right? So we now put our stop loss at this level, 1.17910, right? We put our stop loss at 1.17910, which means if this market goes against us up to this level, it will stop us out. If the market continue going up, we won't be in a losing trade again. We would have been stopped out at this level from losing, right? Now this is our exit strategy of stop loss, right? Now the take profit strategy is also an exit strategy, that if this trade goes in our favor, and okay, let's say we set our take profit level to this place, right? And in the next 1 to 2 hours or 4 hours, this market drop to this level, right? So if it drops to this level, because we are in profit, it execute and close the trade in profit, because we've set 1.17587 as our take profit level, right? So when the trade gets to our take profit level, it takes out the profit and discontinue the trade. When it goes against us, the stop loss takes us out of the market with the loss we've already determined that we want to bear, and stops us from losing further. That's why we have the stop strategy, the stop loss, and the take profit strategy. Now we also have the scaling exit strategy. Now the scaling exit strategy is one interesting strategy. It helps you, it boosts your confidence. So let's look at it now. Imagine this trade goes in our favor and comes down to this level, right? If this trade comes down to this level, whereby price comes down to this level, right? Now if we have previously marked this place as our stop loss, follow me, this is our stop loss, the point where we have 1.17910 as our stop loss, right? Now if we now saw that our trade has now gone in profit down to this level, but we want to edge, right? We don't want, in case the price reverses back, it takes us back into a losing trade, right? So when the trade goes in profit, right, then we now move our stop loss from 1.17910 down to this level, 1.17678. So instead of our stop loss to be behind our entry level, it is now in front of our entry level. So even if price is trying to reject back to our entry level, would either break even or close with a small profit, and then we have nothing to lose. Fantastic exit strategy. So now when you have already locked in some profit, you are confident to leave your trades running, right? You are confident to leave your trades running. That's it. So that is number 5 methodology, of creating a strategy that works. Yeah, of creating a strategy that works. Awesome. Number 6, we have, what candlestick pattern do you look out for? Now, candlestick patterns are often used to predict the future price direction of price action, right? Now, I will give you 2 examples of the most looked after candle pattern of mine. So personally, I look after the engulfing candle, and I look after the hammer, right? The engulfing candle and the hammer. Now you look at this here. Now this is the bullish engulfing candle. Now the bullish engulfing candle pattern is a candlestick pattern that forms when a small black candlestick is followed by the next day by a large white candlestick, the body of which is completely overlapped or engulfs the body of the previous day candle. Now it's as simple as this. So you see this candlestick here, this green candlestick, right? Then this red candlestick, now you see that this green candlestick overlaps this red candlestick, right? That's how we call it engulfing, because it swallows up. It engulfed the previous candle. Just as you can see, this green candle engulfed the previous candle. Then the market start moving up. So when you spot this engulfing candle, it's a very critical candlestick pattern, especially when it is in the higher time frame, like the daily, the 4 hours, the weekly time frame. All right, awesome. So these are the kind of candlesticks I look out for. Okay, now the next one I look out for is the hammer. Now don't forget, we have, this is just the bullish engulfing candle. We have the bearish engulfing candle, where the reverse of this, where we have a bearish candle, right, enveloping a green candle. So this like this signals a continuous fall in price, right? When a bearish candle engulfs a previous bullish candle, right, or a previous candle, either it is red or green. Do you get it? Awesome. Now we go to hammer. Now you look at this hammer. The hammer pattern is a single candle bullish reversal pattern that can be spotted at the bottom of a downtrend, at the end of a downtrend. Now you can see, look at it here, can be spotted at the end of a downtrend. So when there's a downtrend and a hammer is spotted, it's a signal that what there is a reversal. There are several hammers in our chart, so when you spot them like that, it's a signal of a reversal, especially when it is in a higher time frame. When it's in a higher time frame. Okay. Now this hammer, we also have the reverse, the bearish reverse, where we have probably an uptrend, a consistent uptrend, and then a pin bar, we call it a pin bar or reverse hammer, appears. This shows that the market is reversing to a bearish movement, right? Awesome. Okay, so the next one, we've looked at what candlestick pattern do you look out for. This should be part of your trading methodology. Then number 7 is, what chart pattern do you look out for? What chart pattern do you look out for? these are very, very essential. Now let's look at these chart patterns, right? Come in, I want to give a quick, okay. Now I want us to spot. I want us to see if we can spot. Okay, I think we did on in our okay. Okay, awesome. I want to look out for a bullish. Okay, look at armor. Do you see an armor here? Do you see an armor? Oops. Okay, let me look at this armor, right? Look at this armor appeared here, after which there was a big drop. Okay, so you can see armors appear at the very peak. You see the market has been up for a while, and then this armor appeared, and when it appeared, we saw what happened. Let me bold in it so we can, right? So we can, okay. Where is the hammer that I saw now? Oh my god, I saw an armor. Sorry, because I bolded it, so made it. But I saw an armor. Yeah, come out, armor. Ooh, I can't find you because okay. Let's see what we can. Let's see if we can spot our armor. Let's see if we can spot our armor. Okay. Armor, let's spot you. Come out. Awesome. Look at it here. So you can see a big drop coming after that armor. So that's like an example of the candlestick pattern. So you can look out for yours and look at it. Okay, what candlestick pattern do I want to trade? What candlestick pattern do I want to trade? Number 7, we have what chart pattern do you look out for? What chart pattern do you look out for? So you could see right here we have several chart patterns. We have the head and shoulder, we have the rectangle pattern, we have the pen chart, we have the flag, we have the symmetric triangle, we have the ascending triangle, we have the double bottom, we also have the double top. Okay, so the head and shoulder is a reverse pattern, right? It appears in a market that wants to reverse. Let's say in a bullish market where the market has been going up for a while, where the market has been going up for a while, then the appearance of a head and shoulder shows reversal, while the market is ready to keep or reverse backward, or downward. So the same is applicable to when the market is going down, then an head and shoulder appears. So it's an indication that the market wants to reverse back up, right? Awesome. So we have a rectangle. When you see a chart ranging, then you draw your line to identify the levels, and then you are able to pick the trade when it breaks out, and then you enter at this level, and then the market keeps going. Or if it comes and breaks out at this level, then you short so that the market keeps going and you are in profit. So you need to understand identify what chart pattern you are looking out for. One of those chart pattern that is very fantastic that I look out for, I'm not going to say fantastic, but I'll say fantastic to me. To you, it might be any other thing. Do you get it now? So I'm not endorsing one chart pattern over the other. All chart pattern are profitable as long as they suit your strategy, right? So personally, I want to spot a ascending triangle, right? I also want to spot a descending triangle. I want to spot a descending triangle where I can short the market from here, and then or I spot an ascending triangle. Sorry. Or I spot an ascending triangle. Oh, right, where I can buy at this level, right? So you can pick yours. Now you see double bottom. As I was explaining the Euro USD chart, I talked about the double top, right? Let's have a quick look and a quick grasp of what I was talking about. Okay, awesome. So if you look at the weekly time frame, you would see a double top, right, on her Euro USD chart, right? This is one top here, this is another top. Okay, let me see if I can insert a shape. I use a shape to make bold that level. Okay, coming. Okay. Okay. Right. Let me see. I want to make it very clear for you guys. Okay. So as you can see, this is a double top, right? I've just spotted a double top. Okay. So when you see a double top, it's an indication that the market will go bearish. That would most likely go bearish, like coming down. If it breaks out of this place, it's my fall further, right? That's what a double top is telling you, is communicating to you. Okay, that's it. So you want to look at it. What chart pattern works best for me? Do you want to, after this workshop, you want to now start looking into identifying this chart pattern, because these things must be in your trading strategy. Don't forget, we started from number 1. What type of trader are you? You write it down. Number 1, what type of trader am I? Swing trader, day trader, blah 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 trader. Number 2, you note it. You are already developing a strategy that works, right? Okay, so number 8, we have what's your risk to reward ratio? What's your risk to reward ratio? This simply means, what are you willing to risk? How much are you willing to risk per trade? For how much are you willing to gain? So it's a give and take. If you are picking a trade, you want to look at it. Okay, if I'm looking to make this particular amount on this trade, this is the amount I am willing to lose. So am I willing to make twice as much as I am willing to lose? Or am I willing to make 3 times as much as I am willing to lose? Am I willing to make 4 times as much as I am willing to lose? So you need to look at all this. They are very, very important. So the risk to reward ratio measures how your potential reward is for every dollar you risk. So for every dollar you risk, for every dollar you trade, how much are you willing to risk? Right? So for example, if you have a risk to reward ratio of 1:3, it means you are risking $1 to potentially make $3. Is that clear? So if you are using 1:2, it means you are risking $1 to potentially make $2. If you are looking at making 5 times the amount you're willing to risk, which is 1:5, you are willing to lose, for every $1, you are willing to lose $1 for every potential $5 you want to make. So this is risk to reward. You are weighing them. You're putting them on a scale. How much am I willing to let go, and how much am I willing to make? Right? Awesome. So if you are willing, if you have a risk reward ratio of 1:5, it means you are willing to risk $1 to potentially make $5. So it's very, very clear. It's very, 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 very clear. So if you have one ratio, if you have 1:1, so if you are making $60, you are willing to also lose $60. That's also this 1:1 means. But if you have 1:2, if you are making $80, which means you are willing to lose half of this $80, which is $40. Right? That is it. That is just it. I believe you get it. I believe you're following. Awesome. Now, number 9. Determine your risk management. Determine your risk management. This is stop loss and take profit. At this point, we're talking about stop loss and take profit. Now, both stop loss and take profit orders are basically, what you as a trader, you are telling your broker when to close your trade. A stop loss is designed to let your broker know how much you are willing to risk with your trade. A take profit is pretty much exact opposite. It tells your broker how much you are willing to make as a profit with one trade and close it once you are happy with the amount. Right? Now let me take you guys practically on a journey on our trade. Right? So we've taken a trade here, right? And we sold at this level. Now if we are looking at, we need to set we need to put in some risk management in place. Then we say, okay, I'm putting my stop loss at 1.1792, right? And then I'm putting my take profit at this level, which means I believe that if it comes down, it's going to touch this level, and I'll close in profit, right? And if it goes up, it's going to close me out at this level, right? So this level will be my stop loss, and this level will be my take profit, right? So my stop loss is an instruction to my broker to close this market for me, to stop me from losing more than I am willing to lose, right? Because the amount I set on my stop loss is the amount I am willing to lose, right? The level at which I'm comfortable the price getting to against me and closing the trade. Okay, awesome. Let's get back to work. Now, lastly, backtest your strategy. Backtest your strategy to evaluate the performance. Backtesting is a key component of effective trading system development. It is accomplished by reconstructing with historical data trades that would have occurred in the past using rules defined by a given system or a given strategy. Now, don't forget, all I have taught you work, right? Now, you want to now look at it. What type of trader am I? What type of candlestick pattern am I looking at? What time frame am I looking to trade? What chart pattern am I looking at? What's my risk management? You've listed all those things. Now, you now take all those things and start practicalizing them on a demo account, right? So you backtest your strategy, you test it on the demo account. Am I a good scalper? Am I good at scalping? Am I good at spotting short-term profit? Am I a day trader? Am I a swing trader? Do I make more wins when I hold my trades for days? Do I make more wins when I hold my trade for weeks? So you want to identify by backtesting, checking out on your demo account to look at, okay, what type of strategy, what type of chart pattern, what type of time frame. This, according to this 10 methodology I have given you now, you now go and backtest them and check, or you want to check it out on previous data. You want to look at how ascending triangle have responded in the past. It might not be that you take it a trade on demo account. You might just go to your real account and look at identify all the ascending triangles for the past 6 months, or for the past 1 month, or for the past 3 months on various trades, and look at how ascending triangle had responded. Ascending triangle, had it responded bullish? How many times has it gone bullish than bearish? If it has gone bullish 80% of the time, if all the ascending triangles you have looked at have always gone bullish, then you want to look at it that, oh, ascending triangle is always responding to a bullish momentum. Oh, descending triangle is always responding to a bearish momentum. So this is how you develop a strategy, a winning strategy. Look how fantastic it looks like. So, but then you need to be determined. You need to be willing to put in the work. You need to focus. You need to be committed, right? So you don't want to start jumping on one strategy to the other. Just compose yourself. Pick out, what chart pattern, you test it. Does it work? You look at previous data. Does it work? Oh, candlestick pattern, bullish engulfing candle. How much has this bullish engulfing candle gone bullish whenever it appears? How much has the bearish engulfing candle gone bearish whenever it appears? On what time frame does this chart pattern become very significant? I want to believe that you've learned a lot this day. I want to believe that you've gotten the best from today's class, right? I want to believe that you've learned something new, and you must be very proud of yourself that you didn't miss this workshop. So I recap: the methodology in creating a trading strategy that works are in this 10 methodology. 1, what type of trader are you? 2, what time frame works best for you? 3, what currency do you want to trade? 4, determine your entry point. 5, determine your exit point. 6, what candlestick pattern do you look out for? 7, what chart pattern do you look out for? 8, what's your risk to reward ratio? 9, determine your risk management, stop loss and take profit. 10, backtest your strategy to evaluate the performance. Thank you very much for attending today's program, today's workshop. If you have any question, let us know in the comment section. And in the absence of no question, we would like to bring the workshop to a close. Okay? All right. Thank you very much for making it to today's webinar. Appreciate you. Keep learning. All the best.